Women often take a more conservative approach to investing. So is that actually a bad thing, or could it be a smart strategy, in some cases?
Truly. So women take a micro look, anything. It's just not investment. If you notice at your home also, between husband and wife, mostly wives will be looking thing all around. What may go wrong, everything, they'll balance out everything. But men, they are out there, they will not think about what negative may happen. Usually they'll take risk. So same if we'll play it with investments also. So women will make an effort to at least save their capital. So as Warren Buffett says that you should not lose your capital, protect your capital and then other thing. So when women are investing, then I believe they'll make that effort that if I'm investing my money, will I lose my capital? So they will have that thing in mind. Returns will come next. First, they will try to secure their capital, principal amount.
Welcome to Wealth Creation Simplified, a special Paisa series powered by Bajaj Finserv Mutual Fund, where we break down the essentials of smart investing, milestone financial planning, and building long-term wealth. Whether you're just getting started or looking to level up your investment game, this series is designed to make mutual funds simple, actionable, and relevant for young investors like you. With that, let's jump into today's episode. Today, we are talking about something that makes investing truly meaningful: milestone investing. Whether it's buying your first home, saving for higher education, or planning for retirement, aligning your investments with your life goals can make all the difference. But how do you set the right financial milestones? And how do mutual funds and SIPs help you get there without feeling overwhelmed? To break it all down, we have Aprajita Sharma, a seasoned journalist and personal finance expert who has spent years simplifying investing and wealth creation for everyday investors. She's here to share insights on goal-based investing, the challenges women face in financial planning, and how to strike the right balance between short-term and long-term financial goals. So if you've ever wondered how to invest with purpose and reach your big financial milestones, this episode is for you. Let's get started. Aparajita, welcome to Paisa. Thank you so much for doing this.
Thank you, Anupam, for having me here.
Great to have you. Let's start. Investing has changed a lot in the last few years, right? Tech, fintech, new asset classes. What's one big trend in investing right now that you think young investors should pay attention to?
Okay, so a lot of trends are happening and they are much more expert than us to catch those trends, because we are into personal finance and we understand that investment is boring. We treat it like that and we are there in the long game. But them, they are youngsters and they are fresh, their mind, and a lot of things they are catching up. They are tech savvy. So I personally know people who are in their early 20s, just passing out from college. They understand that how algos work. They understand that how FNOs work. They will write strategies and follow those strategies and make money. So if I tell them that this is what is happening and you must follow that, so I will sound preachy. So in the beginning, in the podcast, I don't want to sound preachy. So for them, I should say that there is one core trend that never fails. So you have to follow that trend. And the trends that are going on, if you are following those, well and good. If you are making money via even FNOs or even algos, that is fine, do that. But don't put all your eggs in one basket. You need to understand that you need to set aside some amount of money for the long game in mutual funds, doing SIPs. Then only you will understand the impact of compounding. So these people, they catch the trend that are going on, but they don't understand the concept of compounding. They do, but until you realize it, until you live it, you would not understand what it is. So in the beginning, if you from the very beginning, from early 20s, if you have been investing some amount of money in mutual funds, then in 4 or 5 years you'll realize what has happened. So this is the core trend that people must focus on.
Very interesting. The operative word being if you make money in F&O. Right? Okay, so you've spent years breaking down personal finance into real world relatable advice. Was there a moment or experience that made you realize that investing needs to be tied to life goals rather than just chasing returns?
Correct, truly. So even when I was unmarried in my 20s, then when I would sit down and think about my life goals, then I wouldn't come up with much any goals. I'm not a materialistic person, so I don't want to buy a new phone or gadget. That was never in my mind. Then what to do? Then obviously I only focused on wealth creation, something that retirement has to happen. So I started doing it that way. I did not chase returns in that sense. But linking goals with investment is very important. Again, I'll share my personal experience. So, okay, in the beginning, I did not have any goal. Then I got married, and then husband and I decided to buy a house. Now we'll need money for that. Some down payment amount we'll require. Now my husband is also a stock market journalist, and he is 100% equities. Then I had to make that balance. So I would invest in equity mutual funds, but I would also set aside some money in FDs and debt so that we have that balancing asset allocation between us. So that happened. So down payment, etc. Very recently we bought a home, and that happened fantastically. We could manage, and his amount of money obviously had better returns. Then we had that wealth amount in it, and with me came that stability. I had liquid amount of money, so whatever initial money we had to deploy, I could do that. But we still had some time to make the final payment. So wealth creation happened with his money. So that way it was quite well. But where we failed was that then you would also need money to construct home, then interiors, all those things. So we had no money linked to that. We had money in stock market, but nothing as such liquid linked to that. Now stock markets are falling. So and our work is going on. So we are really troubled about it, that how do we manage it? We are managing it. We don't want to sell our stocks because we know that it will again go up. So that is my message for all, that I have lived it personally. Unless you are linking your goals with maybe a mutual fund scheme or with stocks, unless you are doing that, you won't be able to achieve that. You can't rely on stock market returns. It can go any time down, and you need money maybe after a week. And then suddenly COVID happens, then what? So you need to have that goal set, and when that goal is maybe 5 or 6 months away, or even a year away, in case of child education, I should say that if it's a year away, then you need to take out that money from the stock market and keep it liquid with you. Then only the element of wealth creation plus returns will happen.
Let's take your example and apply it to everybody else also, right? Like when you said that you didn't really think of milestone investing, goal-based investing. See, that's the point, right? Milestone investing sounds great. Okay,
Right.
but let's be real, right? Most young people invest for wealth creation and not for goal-based investing.
Correct.
Okay.
Very true.
How do you make this concept work and not just, make it like a to-do list or something there?
Yeah, here what I feel is that we may have only two goals, long term and short term. Where you are attaching it, where you are linking it doesn't matter. Either you will have goals which are 5 years away, or you will have something 1 or 2 years away. So why not have just two baskets, long term and short term, and do it like that? No to-do list. You are in touch with maybe any financial advisor, they'll tell you to list goals, then you will not have any. I did not have any in my 20s. Then what to do? To simply have two goals, long and short.
Very interesting. Okay, so now let's look at someone who's in their 20s. Okay, first job, first apartment, first big trip, first car. Okay, major life moments. All of them come with financial decisions. Okay, so how should someone in their early 20s start planning, like actually planning for these milestones without
Right.
being overwhelmed?
So very simple. So the moment you start earning, you need to apply it. It sounds cliche. You need to apply that budgeting rule of 50, 20, 30. Sounds cliche, that is there, but that is the way to go about. These days what happen, usually people, they live paycheck to paycheck. They will say YOLO, you only live once, then you have to maybe spend everything. But from the beginning itself, you need to have that mindset that yes, you are going to have your expenses. So 50% are for your expenses. Then 20% you need to set aside as investment. At least 20% money you can save. And then you should deploy it somewhere. And the best way to deploy it, start with Simply Nifty Index Fund. So that 20% money, your salary that you are getting, you need to invest. And the simplest way to start investing, your first investment could be Nifty Index Fund. Then talking about that 30% is your want. Either you can spend it, YOLO. You want something to spend, you want expensive clothes, expensive gadget, etc. So that 30% amount you can keep saving, and that's how you can approach it. But you and then people who may want to decrease their want and maybe setting aside more money in investment side of it, then obviously that can be more than 20%. That's a personal choice. But this is how, if you're disciplined, if you have a disciplined mindset, then I believe you can make that balance. You can live your life and you can also get your wealth creation done simultaneously. So that is how I did it. That is how.
Sure. Let's, now talk about a very big topic, which is women and investing, right? Money decisions impact everyone, okay? But there's research that shows that men and women approach investing differently.
True.
Quite often, right? Why do you think this is? You think it's because of financial education, cultural norms, or something else entirely?
In my observation, it is cultural norm. Things are changing now. But if I talk about women of my age in 30s, in 40s now, then what happens in the childhood when maybe you have a sibling at home, you have a brother, and then sister and brother, they are at home and parents are there. Then if they want to send a child to maybe a grocery store here and there for some household work, then they might give that money to the son, and then son will go out and get things done. So that money relation, that transaction happened. So he will learn that. Daughter will not be asked to go. That cultural thing is at play here, that usually sons go out, women, usually daughters will be home. It's maybe for protection reasons. It's not really that they think that they are dumb. It's just to protect them. Usually men go out, so sons go out. So similarly, when both will grow up, then father may take the son to the bank. Then those banking transactions, the brother will learn. Again, sister will lose out. So that is how in the beginning itself, that she's not getting the opportunity to face that. Abhi things are changing now. Is more often than not single child, so just a single daughter is there. Obviously she'll learn, but between daughter and son, usually that is the cultural difference that I notice. And then when the daughter grows up, then obviously she'll rely on father or brother or later on husband to make to get those money decisions. But interestingly, even men don't know how to invest, although because investment is a complex matter. But between husband and wife, for some or the other reason, wife will feel that he will know better, but that is not the case. I have seen it personally all the time, just that they have that courage to take decision. But if we'll get into nitty-gritty, so even if wife learns it, then they can do it much, much better. Just that you have that mindset that they have more experience in that.
Very interesting. And there's one more interesting thing that research shows up, right? It shows that women often take a more conservative approach to investing. So is that actually a bad thing, or could it be a smart strategy, in some cases?
Truly. So women take a micro look or anything. It's just not investment. If you notice at your home also, between husband and wife, mostly wives will be looking thing all around. What may go wrong, everything, they'll balance out everything. But men, they are out there. They will not think about what negative may happen. Usually they'll take risk. So same if we'll play it with investments also. So women will make an effort to at least save their capital. So as Warren Buffett says that you should not lose your capital, protect your capital and then other thing. So when women are investing, then I believe they'll make that effort that if I'm investing my money, will I lose my capital? So they will have that thing in mind. Returns will come next. First, they will try to secure their capital, principal amount. Men will not. They will take risk, which is why you see all these during COVID also, FNOs, etc. So that happens. They don't understand what negative may happen. Obviously, it's a gender stereotypical, we don't get into it. But if we have to journalize, then that is how things work out.
Let's talk about something that's very specific and very, I would say, common with women, is that they often take career breaks, maternity, caregiving, which can actually make investing trickier, right? So what's the best way to stay financially independent even when stepping away from a job?
Yeah, so for that you need to obviously plan early, and this is difficult, I should say, because in the beginning when you will be having a child maybe in your early 30s, then obviously you are in the beginning of your career or mid-level career. Then IT jobs etc. is a different matter, but otherwise your salary will not be that great. Then how will you save for that short break? Very difficult. If somebody can do it okay, well and good. But better to maybe prepare yourself to live that period. You have that maternity break which is there from employer. That is fine, but you need to keep yourself active. And I believe when you juggle with multiple things, then only you are more efficient. So that thing of taking care of child also, that can very well happen, I believe, with the job also. And I've seen it personally among my acquaintances. But people who are home all the time, they may not have their mind active. The more mind you use, the better you get at it. So break is fine. The only way is to start early, understand, and saving for that time period. But I believe that is not practical. Very difficult to do it.
Yeah.
So better to keep earning some here and there.
I like the fact that you've made a very strong case for being efficient and being multifaceted rather than just sticking to one thing. So some people hand over financial decisions to their partner or family, but that can also backfire.
Correct.
So how can women, or for that matter anyone really, make sure they stay in control of their own money and investment decisions?
Okay, so if you want to have a control over your money, then you have to get educated about how finances work. So you need to put in that time to understand. And if sometimes what happens, husband and wife, they are cool with how to manage money, etc. They are on the same page, then no problem. You can discuss. But sometimes between husband and wife, sometimes there could be some mistrust. In those cases, you need to learn yourself that how to do it. And if you are not able to do it, then better to then outsource it to a financial advisor. And there are a lot of groups now on social media, a lot of women-led group. So women can be part of those kind of groups and then get into discussion. So I am part of one such group, and I see women homemakers posting their queries. So they will ask if sometimes women may have some saving here and there. By budgeting, they will save some amount, lump sum amount. Then they will ask where to deploy it. I don't want to reveal this money to my husband, but I want to do something for my child. Then how do I do it? Then in that group, people will tell her that invest Nifty index fund or gold mutual fund mein dal do, all kind of things. So such discussions happen. So that those women are making some effort, and they got that trusted group, closed knit group where they could ask their questions, and that too anonymously you can ask. You don't even have to reveal your name. You could be part of the group, but your name could be anonymous when you are going to pose that query. So make that effort. Then this will help.
So really the important point out here would also be trust and transparency, right? That you need to trust your partner, be transparent about your money things. I mean, that always forms the bedrock of any financial decision, any relationship for that matter.
Correct.
Okay, now coming back to investing in milestones. Now, every Gen Z or young investor has a long wish list, okay? Travel, home, side hustles, early retirement. How do you prioritize this? Early retirement, yeah, I know. How do you prioritize what to invest for first without feeling that you're missing out on something else? #FOMO.
So again, investment, I believe, is mostly the long-term thing. Short-term goals we talk about, but mostly it's a long game. Again, going back to 30-20 rule, 50 is expenses, you can't help it. But that 30% of your salary, you can invest in your wants. If you want to have something expensive, if you want to go on a world tour, any your Euro trip, all those things, then why not? You have that 30% of your salary marked to your wants, marked to your wishes, then do that. But that 20% should have that realistic goals, that you will have the early retirement. Okay, then you need to go to Google and click on different calculators and understand that how much corpus you need by that age. If you want to get retired at 40 or 50, so do those calculations. Then you yourself will not feel like spending on any other new phone. Your existing phone, you will love it. So that is also there.
50, 30, 20 sounds great. My thing is with the estimations going wild. Right?
Okay,
because most people, now this is not about young old, it's in general, most people totally underestimate how much they actually need or for things like buying a house or retirement. Is there a quick rule of thumb or formula to figure out realistic investment targets?
Realistic investment targets will have to have some figures, money, etc. And if somebody is not able to do it themselves, then I keep talking about it, that for different things, for, as we say, for medical needs, we go to doctor, then why not hire a financial advisor? I have 10 multiple stories where some people, youngsters in their 20s, they have gone to a SEBI registered investment advisor. So they go to them, they sit with them, they understand their, then you'll be able to make those realistic goals. And if you'll tell them that you really want to have something expensive to have, so they will help you out that how to manage your money in a way that also happens, but you don't lose out on your realistic long-term goals also. So they can very well help out. So why don't people get into this thing? Annual, it's some amount of money on an annual basis, and if you'll get into monthly basis, that this will be a very small amount which you may be spending only just you go to a restaurant spending on dinner. That amount on a monthly basis, if you accumulate for 12 months, very easily you can afford a SEBI registered investment advisor. Then why not do it?
Why not do it indeed? Okay, what's one financial milestone every Gen Z investor should aim to hit, say, in their mid-20s when they start their job, by the time they hit 30?
Okay, so if we take an example of a 25-year-old, so that 25-year-old, it's a logical assumption that he can shell out 10,000 rupees a month. At least this much saving can happen. And if this person invests 10,000 rupees for 10 years, at the rate of 15%. Now, why 15%? So it has its own logic. I have personally also seen that 15% compounded annual growth rate is easier to get. But again, it's a hypothetical number. It might vary. But I have done my calculations at 50% for this thing. So if you're investing for 10 years at 15% rate, 10,000 rupees, then you will get 27.86 lakh in 10 years. So 25-year person turning 35. By the time maybe he'll get married, having a child, then he will have this amount. Now, when the same amount, if you continue for 15 years, again at 15%, then you will accumulate 67.8 lakh. Now comes the beauty. A 25-year-old investing 10,000 for 20 years at 15%. Now the person turns 45. Now he will have 1.5 crore. So by the time his children, they are going for higher education, so he will have this much amount of money just by investing 10,000 just in a disciplined manner. Now in 30 years, usually people go for early retirement. So if you want to get retired maybe by 55, then by 55 years of age, you will have 7 crore rupees. And this is not hypothetical figures. 15% is the hypothetical figure, but all other these calculations, you can yourself do it online. Simply go to any SIP calculator, put in these figures and look at it yourself. You will realize the power of compounding, the magic that compounding brings. And that is my message, that before 30, if you are in your 20s, this is what you have to do. Simply start investing. Doesn't matter if it's 10,000, 5,000 or even 1,000. Whatever you have, whatever spare money you have, just start investing.
Aprajita, finally, if you had to give one golden rule for milestone investing, what would it be?
See, we have initially also, I referred to this point, that golden rule is that you have to have you have to get your asset allocation well. So as I mentioned about short-term goals and long-term goals. So at least have these two goals. Long-term could be in equity, short-term could be in the combination of debt and equity. You would need to have at least 70-80% of debt and little bit of equity when you're talking about short-term goals. So this is the golden rule of investing. This is the golden rule to achieve your milestones. You need to have that balanced asset allocation.
That's a wrap on today's episode of Wealth Creation Simplified. We've explored how milestone investing can turn life goals into financial realities, why prioritizing investments is key, and how women can take charge of their financial future with confidence. A huge thank you to Aprajita Sharma for breaking it all down in such a practical, no-nonsense way. Whether it's your first job, first home, or planning for the long term, the best time to start investing was yesterday. The next best time is today. Thank you so much, Aprajita.
Thank you, Anupam. Pleasure being here.
If you found this episode helpful, make sure to like, share and subscribe to the Paisa Vaisa YouTube channel and follow us on your favorite podcast platform.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.